I'm going to start from the last chapter, Wounds Heal Scars Last. I mean, you write a lot at the intersection of psychology, finance, investing, and markets. Uh, this is a chapter where you talk about, how, certain events just change the way people think about money. I mean, for example, somebody born in the 50s will think very differently to, let's say, somebody who's born in the 90s. And obviously, the COVID-19 incidents would have again changed the way people think about money. So if you can just elaborate on it, because I found this chapter very fascinating, and a lot written in this chapter is also connected to your earlier book on psychology of money, on how people think about investing.
Yeah. So, I mean, everybody, myself, you, everyone in the world is a mirror of the experiences that they've had in their life. We all want to think that we are thinking independently and like looking at the broad world and trying to figure out how it works. And to some extent we can, but everyone is just a product of the experiences that they've had. And the majority of those experiences, particularly the big ones, are not in your control. It's where and when and to whom you were born that shape like the majority of your worldview. So let's not pretend that I think about the world in the same way that my grandparents would, or that if I were born in China or Africa or Japan, that I would think the same thing about the world as I do today, as somebody who was born and grew up in the United States. Everyone's a product of those experiences. And then there are the traumatic experiences that we might experience, whether it is the Great Depression or a global war or a pandemic that we all experience very differently. COVID is really interesting because it's one of the only major global events that people experienced very, very differently. So in 2020, if you owned a restaurant or a laundromat, it was worse than the Great Depression for you in 2020. Business went to zero. But if you worked in tech, if you worked at Google or Microsoft or Apple, it was probably the best year you've ever had. You made more money and had more job security in 2020 than you've ever had. Because of that, the totally different experiences that people have had over the last 3 years puts us in a situation where half the world does not understand the viewpoints of the other half. And you have half the world who's saying, like, what are you worried about? Like, everything's been great. Stock market's done well. We've made a lot of money. And then another half who just says it's worse than the Great Depression. And the experience of that will stick with people forever, for the rest of their lives. Just as the people who grew up during the Great Depression, that stuck with them for the rest of their lives. So I think when like a big part of this that's really important, maybe this is the most important part from Same as Ever. Whenever you see somebody with money who is making a decision that you disagree with, they invest in a way that you don't agree with, they're saving or spending their money in a way that you think is wrong, the huge majority of the time, you don't actually disagree with that person. What's happening is that person has different goals, different time horizons, different social aspirations, different risk tolerance than you do because they've experienced something that you have not. And so rather than saying, why are you doing the things that you do? A better question is, what have you experienced that makes you believe that? And if I experience that same thing, would I believe the same thing myself? And most of the time, the answer is yes. That, there are people who invest very differently than I do. And rather than criticizing them, I think the important thing is to realize that if I lived their life, I would probably invest that way too. And if they lived my life, they might invest the same way that I do too. So I think it's a very humbling experience to just take a step back and realize that we are all just products of the dumb luck of what we've happened to experience in life.
So, one of the things which is most fascinating, I was always going crazy about the stock market. We are in 24/7, we're in stock market. And it is at one level, it is most irrational place in the sense that it's the biggest game in town. And yet it's biggest, I think, craziest things happen here. Maybe because the game is biggest, you find the craziest thing. And yet it cannot be taught in a classroom. Open heart surgery can be taught in a classroom, but you can't teach stock market. And the game is so big. I'm running into trillions now. Single guy can create $1 trillion in one lifetime. So, and yet, one of the things you said in page 67, that is just a number from today multiplied by a story about tomorrow. The way. So it's what I'm saying is that this game is big, $100 trillion global GDP, $100 trillion market cap up for the world. In next 10 years or maybe 15 years, we'll go to 200 trillion, and the market cap will also go to 200 trillion or more. So the game is going to become bigger every day. and the irrationality probably will also exponentially grow. So how do you think, is that thing which was said in the short run, stock market is voting machine, and in the long run, it's a weighing machine. So how will you rationalize this entire phenomenon?
I think a lot of it, when you see behavior that looks irrational to you, sometimes it is irrational. It's people truly making poor decisions, of course. But a lot of times what's actually happening is that people who are playing a different game than you are doing what is rational for them, even if it would be irrational for you. So you and I are long-term investors. We're looking at the next 10, 20, 50 years as an investor. But there are lots of short-term traders. And who am I to say they're doing it wrong? They're playing a different game than I am. But since they're playing on the same field, so to speak, the same pitch, it can look wrong to you. So someone who is, selling a stock because it had bad earnings last quarter, that's not the game that I'm playing, but maybe it works for them. But because they're selling, it's going to create short-term action that looks ridiculous to me. So I think if you are an investor who looks around and constantly says, investors are irrational, everyone's making bad decisions, everyone's crazy, I actually don't think that's the right mindset. I think you should say, like, look, most people in the world are doing the best that they can with the information that they have. I think a better way to say it is that people play a ton of different games in the stock market, and you need to go out of your way to define which game you're playing, and then only seek your information and your cues from people who are playing a similar game than you are. The other takeaway from that is when you realize that people are playing different games, and of course it is a very emotional game, regardless of what game you're playing. It's always going to be like that. There's never going to be a world in which the stock market becomes a perfectly rational machine and all of the movements make perfect sense and it's just discounting cash flows. It's never going to be like that. It's always going to be a boom to bust phenomenon for many different reasons. And so I think just coming to terms with it, makes it pretty exciting. I hope to be an investor for the next 50 years. Maybe I'll live to 99 like Munger did. Yeah. And because of that, I know with certainty that it's going to be over the next 50 years, there will be probably 10 bubbles and busts and recessions and crazy bull markets and bear markets. To me, that's actually really exciting. Now, of course, a lot of those will do damage to people on the way down, and that's never fun, but it's never, ever going to be the case where the market becomes a rational machine. It's always going to be wild.
Yeah, Morgan, though we are long-term investors, and today is a amazing day for somebody to be remembered, Charlie. But even in long run, S&P 500, none of the companies that survive beyond 30, 40 years. If you see the list of top numbers in, say, 91, 92, and today, it looks at today Microsoft, Apple, and Google, they're invincible. They are $2, $3, $4 trillion market cap. Who knows, 10 years henceforth, the list will be different. And the issue is that, okay, they may not go to, where will they be? What has happened to the top ranker of 91 today? They're just nowhere. So what I'm saying is, even the long run, whatever somebody thought that is going to be the, say, discounted value in 91, and then they gave the market cap of, say, 100 billion or something, they're also wrong. Yeah. So short run, in any case, there is irrational. The long term also looks to be kind of, it's a storytelling, and somebody is believing it. If I'm saying Apple is, say, discounted value of Apple is $3 trillion today, or over $3 trillion. So somebody is giving me a story that this present value of all the future cash flows is going to be $3 trillion. And Buffett is holding it. You can't find more rational person than Buffett. So he thinks that present value of future cash flow at today's interest rate of 5, 6, 7% in the US is going to be more than $3 trillion. And it's a good investment because he's holding it. So he thinks that it could be worth maybe $4 or $5 trillion.
Yeah.
So what I'm saying, and we know that these numbers are, maybe in one company it could be right, but they're all wrong. If you see the past history, nothing is number one in last 25 years. The rank changes. Yeah. So, so we are irrational on both sides, and yet this game is biggest. So how do you make sense of it?
I do think there are, some companies that can last more than 10, 20 years. Microsoft is, one of the biggest companies in the world, and it's almost 50 years old. But you're absolutely right. If you look back at 10, 20, 30 years ago, a lot of the biggest companies, even if they're still alive, ExxonMobil, IBM, General Electric, General Motors, they're still alive, so to speak, but they're shells of their former self. So I have no idea which of the companies it will be, but you can, if you make a list of the top 10 biggest companies today, I would bet that at least a couple of them will either not exist or be shells of their former selves 20 years from now. To me, the antidote for that is, of course, just diversification. I'm out on the record. I'm an index fund investor. So whatever the biggest companies will be in 20 years, I'm going to own them. I'm also going to own some of the duds. That's just kind of the acceptance that I make. But I think it's even true for Berkshire's biggest investments. I mean, the biggest, most high profile investment that Buffett has maybe ever made, not the largest in terms of dollars, is Coca-Cola, which was an incredible investment for him in the first 10 or 15, 20 years. Yeah. And it's been okay at best for the last 20 years. So I think there's lots of these that kind of fall into that category. I think if Munger were still with us today, he would say, yeah, like adjust your expectations accordingly. It's almost never going to be, hey, I mean, here's one example I would use. Berkshire Hathaway in itself, the stock Berkshire Hathaway has not really outperformed in any meaningful way for a quarter of a century. It's been like this. So I think Buffett and Munger Munger would, if he was still with us, say, yeah, you should adjust your expectations accordingly. Berkshire had incredible, ridiculous results for 30 or 40 years. And of course you should expect that after that is going to come a period of relative mediocrity. I think that in itself is very rational. You should never expect any company whatsoever, or even any economy, to outperform indefinitely. The United States had a very, very good 50-year run from kind of the end of World War II through about 2000. Or actually, I would mark it from like the end of World War II to September 11th, 2001 is where I would mark that. And since then, it's been okay at best. And maybe for the next 20 years, it'll be okay at best. And I think that in its whole is like the best situation that you could ask for. If you can have 50 years of incredible returns followed by 50 years of okay returns, that's an amazing result that I'd be happy to accept.